Well, hey there, everyone. Happy Tuesday, December 16th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a once again rainy Redmond, Washington. We're getting hit with another what they call an atmospheric river, I think is what it's called. Inclement weather coming in pretty hard here. It looks like we're set for a little more flooding. Not as bad, hopefully, as what we had last week. So fingers crossed. But this region has definitely gotten hit pretty good, and particularly our town is one of these. It's in a valley, and so the low-lying areas get caught pretty good when the river swells to the degree that it is. So hope everyone stays safe. Personally, I'm driving into Seattle every night because I sing in the Seattle Symphony Chorale. We're doing the Handel Messiah this weekend. So if any of you are in the area, please consider coming. It's a beautiful concert hall, a beautiful piece, obviously. And the chorale is sounding pretty good, I would say. So we're excited to do the rehearsal with the orchestra tonight. I am hopeful that I'll be able to drive in and out of Seattle in the dark, in the rain, and we'll take care to be careful. Hope you guys are all staying careful and doing well wherever you're at. We're going to get to the charts here in a moment. A couple comments before we get started. I mean, number one, kind of a choppy day, but what you're going to find is the S&P did recover a lot of the early losses earlier in the day, around midday, around 1 p.m. Eastern. It looked like a pretty ugly day for the S&P 500, and certainly for the Dow. Both of them had a decent afternoon, and the S&P basically almost finished flat for the day. It was down about 0.25%, but the NASDAQ back higher. Technology, which has been lagging, was actually up today, but as you're going to see, not a lot of sectors up today. Actually, only 3 out of the 11 finished in the green. The other comment, we're kicking this off a little bit later than normal because I was at the Stock Chart studio in downtown Redmond recording a year-end review with Grayson Rose. That should be out here later this week. Please keep your eye peeled on the Stock Charts TV YouTube channel. It should be a lot of fun. We had a really good discussion about kind of year-end assessment of market conditions, talking about some forward-looking ideas and what to expect. Some of the charts that stand out to us. A really fun lightning round at the end where we hit on some specific things. So I hope you enjoy that. Should be coming out here very shortly. All right, let's continue on looking at the market recap. As I will remind you, this show every trading day after the close has 3 main segments. First off, we'll talk about market conditions. Second, using the market recap here. Second, we'll go to the heat map and talk about some group and stock and sector themes. Then we will look at some charts together. If at any point during our time together today, if a question pops into your brain, please take a moment, use the comments section on our YouTube channel and let me know. We are planning an all mailback episode on Friday of this week, and would love to feature one of your questions on that show. So please share your questions when you can. All right, let's talk about the major averages here. The S&P 500 finishing down about 0.25%, and it was a lot worse. So it finished just above 6,800. So nice recovery. It's actually great to see after the initial losses. It looked like a pretty rough day to start, but nice recovery there in the afternoon. The NASDAQ composite recovered enough to actually go positive in the last hour of trading. It was only up about 0.25%. The Dow, the laggard out of these 3, down about 0.6%. Mid caps and small caps all similar to the Dow, so underperforming large cap and large cap growth. As a reminder, right, the VIX down 16 or so basically implies we should have very small percentage swings day to day in the S&P. That's what the options market is pricing in. This is a measure of volatility, right? Looking at the index options on the S&P and using that to sort of imply what a volatility should look like for the S&P. So this is basically saying the market's suggesting, the options market suggesting we should have days like this more often than not, right? Little small percentage moves to the upside or the downside, right? And a high or low VIX does not imply direction. There is a general negative correlation between the S&P 500 and the VIX, but in reality, volatility is a measure of movement, not directional movement, but just fluctuation. So we remain in a little volatility environment. The VIX, to be honest with you, chopped around a bit, got above 17 earlier in the day, but by the close kind of rotated down. So around 16.5. We're still in a low volatility environment. Anything below 20 in my book. Looking at interest rates actually came down a bit today. This is after the 10-year yield has been breaking out. We saw on the chart of the dollar sign TNX, which is the 10-year treasury yield on stock charts, kind of breaking out of that downtrend channel. We've covered that on previous episodes. Today, rates actually pulling in a bit. The 10-year yield's around 4.15. The long bond yield just about 4.8%. So we do have a steepening yield curve, generally speaking, although today kind of flattening out just slightly. The TLT was up about 0.6%. So bond prices did actually move higher while rates moving lower, which is the traditional relationship there. The dollar was pretty weak out of the open, but overall, not much of a change by the close. One of the things I talked with Grayson Rose about earlier today was precious metals. Talked about, and I forget what the question was where I went to silver, but maybe one of the charts that stood out in 2025. Silver's definitely one of them. The SLV down about 0.6% today, 0.7%. Gold ended up being flat for the day. Silver has outperformed gold year to date, and certainly in the month of December, that's the general trend that we've seen. So today, sort of back to a risk-on-ish kind of move, although it wasn't overwhelming, right? I mean, you see the breadth was not overwhelmingly positive. Weren't significant moves. It was more of a quiet day than anything, but you can see most of the commodity space in the red. And I would say the real movement today was not in gold or silver. It was in energy. You can see the USO, which is a crude oil ETF, down 2.5%. Natural gas, gasoline futures, these were all down pretty big today. We're going to focus a little bit on the energy sector today, looking at a couple different energy ETFs to show you some of the thematic movements that I think we've seen and how weaker crude oil prices generally are weighing on that entire sector here, certainly today. Cryptocurrencies, we can see Bitcoin actually bouncing higher today, up about 1.5%. We're just below 88,000 as we do the show. Ethereum prices just above 29.50. Kind of mixed results for the rest of the top 10 coins. Bitcoin attempting to bounce higher after breaking down what I would say is a pretty straightforward bear flag pattern. In the last 48 hours, we've now completely broken down below that bull flag, that bear flag pattern, and now bouncing higher a little bit. 90,000 was a peak in the last 48 hours. That's a big round number, has often served as resistance. That would be a decent upside target on the tactical time frame if we continue to appreciate from here. You see my voice is wavering just a little bit. It's a lot. I don't know if any of you sing a lot in a chorus of some sort. The Hondo Messiah it's a marathon. It is not a sprint. It is a marathon. It's a long piece and it's very challenging. And I got to pace myself. I got a whole week here. We got 3 performances this weekend, so I gotta lighten up and not oversing. I'll try to do my best. The bad news is I talk for a living too, so I got a heavy voice usage this week. So I'll try to lighten up and use less aggressive vocalizations here during the day for sure. So you may want to turn the volume up a little bit as I try to save the voice here. Out of the S&P 500, 11 sectors, 3 of them finishing in the green today. The technology, consumer discretionary, and communication services, those are the 3 growthiest, the 3 FANG sectors, all up, but not by much, right? The XLK and consumer discretionary, the XLY, up less than 0.25%. Communication services was essentially flat. On the downside, energy getting hit pretty good, down 3.1%. Healthcare, which has been one of the more impressive sectors recently, down another 1.3%. Real estate down 0.9% today. Here's the breadth, and the breadth was not particularly strong today. So again, the 3 growth sectors were up, but most things were down, and that's how the benchmarks were kind of flat. But you're going to see a lot of red when we look at the heat map here in a minute. On the New York Composite Index, 62% stocks down, 35% of stocks up. On the S&P 500, about a 3-to-1 ratio, 73% down, 27% up. So it's generally a weaker breadth day across the board, especially in the large cap space, right? So the weakest breadth of all of these in the S&P 500. The Magnificent Seven, which is a group of leading growth names. We have Tesla continuing to impress, continuing to distance itself, I would say, from the rest of this group of leading growth names for remaining quite strong and even emerging, breaking to new all-time highs this week, as most things are definitely not doing so. Tesla up another 3.1% today. Meta Platforms up 1.5%. Netflix and NVIDIA both up about 0.8%. On the downside, Alphabet, which has arguably been one of the strongest of these names, making a pretty clear pattern of higher highs and higher lows, down about 0.5% today. Now, the problem for the chart of Google is we're actively testing the 21-day EMA, and that's not necessarily a problem. It may actually be a fantastic thing, because if you look back to the end of June, right, look at the third quarter and fourth quarter, so July through current day in December, look at how many times we've pulled back to an ascending 21-day EMA. And even though we've briefly broken that level and maybe closed below it for a day at most, we've bounced off of that level. We're right back there. We've now closed below the 21-day EMA for only the third time since the end of June. So not very often. And previous pullbacks to the 21-day EMA have been really good entry points. On a chart like this, I mean, whether or not you're trading Alphabet, I think it's helpful to pay attention to charts like this, because at some point, that buyable dip does not hold, right? At some point, we either gap below that level or we just blow right through the 21-day EMA. And if nothing else, it tells you, okay, something's different. Dip buyers that have been thrilled to add more Alphabet on every one of these pullbacks are kind of no longer there. There's an exhaustion of buyers. There's a lack of demand, a lack of buying power. I don't think we're necessarily seeing that yet on the chart of Alphabet, but I think this is why it's a crucial chart to watch this week. If things are good and we're going to have a nice, late stage rally, maybe a Santa Claus rally from the end of December into the beginning of January, if we're going to have strength into the beginning of the new year, I would argue charts like Alphabet most likely kind of have to find support here and start bouncing higher. And this is about the time where it's happened in previous pullbacks over the last 6 months. So a crucial chart to watch. For now, holding in there. We'll see if that continues. All right, we're going to go on and talk about the heat map for a moment. Before we do that, I do want to let you know, unfortunate news. Connie Brown, who is a longtime technical analyst and a mentor to many in the industry, has written a number of books, passed away back in October. I actually just learned about this, and it wasn't widely disseminated that this had happened. I'd actually exchanged emails with her back in September and hadn't heard back in a while, and then just heard the news. It was passed around with my number of my friends in the industry, updating on that. Connie was I would say in a lot of ways a brilliant technical analyst. She wrote a ton of books. A number of people, especially outside the U.S., as toward the end of her life, had really been drawn to her use of things like Gann analysis and Fibonacci analysis, some of the more esoteric parts of the technical analysis toolkit. But she certainly had an impact, and I'll share with you just in a way to honor her contribution to the technical analysis community. Last thing I wrote to her was, I can't thank you enough for going out to dinner in New York years ago, for writing a chapter for my book, for being so willing to share stories and insights with me over the years, most especially for giving time and attention to young analysts and novice technicians around the world. It made a difference in my journey, and I'm certain for so many others as well. Be well, Connie. So rest in peace, Connie, and thanks for being a mentor to many. All right, shall we go to the heat map? Knowing Connie and her passion for charts and technical analysis, I would think wherever she's at now, she'd probably be appreciating the fact that we would celebrate her contribution by looking at some charts together and talking about technical indicators. So let's do it. Here we have the heat map, the market carpet. As we can see, a bit of red here, and it's sort of skewed red on the right part of this chart. On the bottom right corner, we have energy, which got hit pretty good today. The XLE, the worst performing out of the 11 S&P sectors. A lot of these names were down way more than the S&P today. For example, like a Valero down over 3%. We can see a lot of these had some pretty significant down moves. I'll show you in a little bit a couple of the ETFs that I track in the energy space. They're all down today to varying degrees, but some of them look way more constructive from a technical perspective than others. And I think that's worth differentiating. We often think of energy as like one thing, but what you have to remember is there's different parts to the energy story, right? They're the exploration and production companies that kind of get the oil out of the ground. There's midstream or pipeline companies where they're actually getting the oil from one place to another. There's the downstream oil, retailers that actually are, you're pumping gas at the retail, gas outlet. And so each of those have kind of different, crude oil prices can affect them in different ways. But all of those groups that I just mentioned down today, we'll look at the charts and you'll see how the configurations are actually quite different. Also noticing a lot of red in healthcare. I mentioned the special coming out with Grayson Rose. We talked a good amount about the healthcare sectors because it was one of those that sort of became a pretty compelling technical story as the year progressed. Earlier in the year, certainly wasn't. And then more recently, we've seen some really impressive moves in pharmaceutical stocks, in some biotech at certain points. But today, you're definitely getting a downward move in a lot of those. And it goes from charts like Pfizer, which have been attempting to, continue this uptrend, still in an uptrend of higher highs and higher lows, but kind of pulling back. Johnson & Johnson actually made a new all-time high yesterday, so pretty close to previous all-time highs. But maybe this is a good one to highlight. Quest Diagnostics. I mean, the chart. I mean, when you take a step back, it strikes me that DGX is just a really good uptrend. This is a 1.5-year chart. We are going from the bottom left to the upper right. So we've had a pretty consistent uptrend. So it certainly feels like this has been a pretty classic, uptrend phase. And we can see on the weekly chart, just look at that really consistent move from, early 2024, really to where we're at now, just this nice pattern of higher highs and higher lows. The problem with something like DGX isn't the price action, it's the relative strength, right? So here's the relative performance of DGX versus the S&P 500. You can see that from the end of December of last year through the major market low in early April, Quest is actually outperforming because it's actually, up for the year while the S&P and the NASDAQ are getting absolutely crushed into the April low. But if you look at what happened after that, it's still in an uptrend, but the relative strength is generally weak. Now, the real negative relative strength was here in May, June, July. Over the last, 4 or 5 months, it's really been more of a market performer than anything. It's sort of sideways. The relative strength, right, is kind of going sideways. But this was the rough part because it really didn't go up a lot. So it went down a lot less than a lot of other stocks did in March and April. But it went up a lot less after that low. And DGX is a reminder for me to remember that relative strength can be super helpful, not just for helping you validate whether a stock that you own is working, meaning that it's helping you outperform, helping you do better than a passive vehicle like spiders or something. But it's also great at just acknowledging, I guess, the opportunity cost, right? If I have my capital tied up in DGX, which is kind of drifting higher, but kind of doing the same as the benchmark, I'm missing an opportunity to own something that's outperforming. I'd much rather own things that are outperforming the S&P at any point, but especially when when something like this is telling me I'm not getting a lot of alpha, right? Beta is sort of the way of describing the market performance. Alpha is sort of like your incremental gain, your performance edge on top of the benchmarks. And so not a lot of alpha on this chart, plenty of kind of beta because it's kind of going up with everything else, but not in a meaningful way that's allowing you to outperform. And I think that's an important thing to think about with some of those charts have been going up, but really haven't helped you outperform too much. Outside of that, financials a little bit weaker here today. Financials have been one of the more interesting emerging areas of strength. Stocks like JP Morgan, Goldman, I mean, sort of these money center banks really making new highs yesterday, pulling back a little bit today. I still think there's a lot of interesting opportunity there. But generally, right, I mean, besides the fact that the growthy sectors were up, I mean, not all of them, right? And in consumer discretionary, like Tesla was up, but pretty much everything else was down today, right? So it's sort of like the Tesla and everything else sector. It's almost like Tesla doesn't belong in consumer discretionary. And don't think I haven't recognized that and pointed that out many times before. When you try to group stocks into individual sectors, you're always making adjustments. I mean, Tesla is a technology company, right? But so many things are technology companies. And so what's happened is it's like, are you using the technology to create driverless vehicles or, process financial transactions or, support a cloud environment? It's like they're all using technology. It's just what they're using it for nowadays. But Tesla feels in some ways, and it's hard, like auto companies, it's kind of a tough bucket because I think they could arguably be put in a couple different sectors to be sure. And Tesla really trades in a lot of ways more like technology than retail names. But for now, it's worth noting big weight in the XLY and good news if you own the XLY because it's up 3.1% today. All right, that's it for the heat map. We're going to look at a bunch of charts here together in a moment. Before we get there, I do want to remind you, last chance, because our last live webcast of 2025 is happening tomorrow on Wednesday, December 17th, 1 p.m. Eastern at 10 a.m. Pacific. session is called Winners, Losers, and Lessons, your year-end investment review. For years, I have asked myself a series of 10 questions as a way of evaluating performance, sort of digging into my processes, learning the lessons of the year, but really looking forward at how I can upgrade my decision-making in the year to come. If that sounds interesting, and if it would help you to sort of devote an hour to self-reflection and improvement of your processes, please go to marketmisbehavior.com/lessons to sign up for that free webcast. You'll be able to use that same link to access the live episode. You can also access the replay when it's ready through that link as well. So make sure you sign up. I'll shoot you an email as soon as the replay is ready, and you can check it out and enjoy it at your leisure. So sign up today at marketmisbehavior.com/lessons. Let's wrap the year with success, shall we? All right, looking at the chart of the S&P, I mean, it's not great. And what I mean by it's not great is just we're not making new highs right now. And we haven't been making a new high on the S&P 500 since the end of October. And I think that's worth pointing out. I got a lot of people. I mean, anytime I say anything kind of not bullish on social media, I get people pointing out why that's just really dumb. And I don't blame you, because the market has gone up a ton this year. It's gone up most years in the last 10 years, to be honest with you. There's been very few down years, and certainly since, 2019, even through a major pandemic, we've only had one big down year. So I don't blame you for generally being bullish. I think that's generally been the right place to be. However, I would, I can't lie and say I don't see anything to be concerned about. I see some issues. The fact that we're not going up anymore. I mean, we're not, right? We're not going down, and that is totally fair, right? We're not breaking down. And that's why I think this stoplight technique is really valid here. I think anything above 65.50 is still fine. It's fine. Anything above 6,900, then you can start saying we're going up again. We're in a big uptrend of higher highs and higher lows. Look, there's the evidence. You cannot say that. That is not being intellectually honest right about now, because we're still below the October peak. Now, we're not a lot below it, right? We're pulling back in the last couple of sessions. We're still at the 50-day moving average. Things are not horrible, but we are not actively trending higher. I would argue this is a sideways trend. I don't think the direction in the market is particularly clear right about now. I could see this resuming higher right around that Santa Claus rally period at the end of the year, between Christmas and New Year's, beginning of January. Nice rally to start the new year, gets everyone all excited as we kick off 2026. I could see that as a possible scenario. I could also see a rotation lower, similar to weaker Decembers we've had in like 2018. That's happened before, right? It doesn't happen often, but it happens. So I think at this point, it's sideways is the primary direction that I'm seeing. Today was a doji candle, by the way, with the open and close right around the same level on the S&P 500. Now, one of the great benefits we have looking at the equity space is we can look a level lower, a couple levels lower. We can look at breadth conditions. We can look at leadership. We can look at where we're seeing opportunities, where we're seeing strength, and where we're identifying weakness. And I would say these ratios, looking at offense versus defense, super valuable, right? If you ask me what would tell me that conditions are really getting ugly, I would say an improvement in defensive sectors. That could be things like real estate, could be something like healthcare, which is often sort of a defensive sector. Utilities, which is more growthy at times here in 2025, but still generally speaking, a lower volatility, more defensive sector. And then consumer staples. And this ratio of consumer discretionary versus consumer staples, a classic way of evaluating offense versus defense, whether equity investors are going more risk on or risk off. These aren't going down here in the last couple of weeks. These ratios are both going higher. The cap weighted and equal weighted versions are both trending higher. And I think that's something to be optimistic about. At some point, these start rotating lower, and that's where I would be concerned. This is what had us concerned at the beginning of October, certainly going into the month of November, as we saw that ratio rotating lower, favoring defense over offense. Overall, still in good shape here in mid-December. The GLD, I mean, right at new all-time highs. This is the GLD, which peaked around $403 mid-October. We have now round-tripped back up to that point. After a pullback to the first main Fibonacci level, we have rotated back higher. We now have 3 straight candles, which are solid candles. So instead of plowing through the previous high and accelerating, we're stalling out here. Every day we're opening and we're closing below the open, opening a bit higher, closing a bit lower. So again, not a horrible chart, not a this is really bad news chart, just a not breaking out chart, right? It's sort of a wait and see type of indicator. So we're testing the previous all-time high. We're just getting up to the overbought region. So certainly just not quite the all clear yet, but we'll certainly look for a break above 400 on the GLD as a good upside validation. Here's what's happening with crude oil prices. We're down to $55 a barrel. We can see a lot of counter trend moves that we've been tracking here over the last couple of years. And going back on this chart, I've been putting these Fibonacci retracements a bunch of times. As we have these rallies, they often stall out around 50% or so, 38.2% maybe of that previous bounce. Most recently, we sort of got up just above that 50% level here in late October before rotating lower. Now crude oil prices are making a new 52-week low today. So the challenge here is this chart has not been above its 50-day moving average since the end of September, and also has been below the 200-day moving average for most of the last 18 months. So crude oil prices are in a primary downtrend. There were times where it looked pretty encouraging, like there might be some sort of upside follow through, but we really have not had that in the fourth quarter really at all. And these rallies have been counter trend rallies to the 50-day moving average before making a new swing low. So the issue there is when crude oil prices are lower, that usually means energy is going to struggle. And we've seen a rotation generally away from technology, by far the biggest sector in the S&P, into other sectors, some to consumer discretionary, like Tesla types of charts, but also into value-oriented sectors. This is the relative performance of industrials, financials, materials, and energy. You can see that these first three all rotating higher in the month of December, all outperforming the S&P, but energy not the case anymore. And energy all of a sudden diverging from the rest of the value space. Now that's the XLE, which is the S&P 500 energy companies. There's a couple of big integrated oil companies like Exxon and Chevron, a bunch of other names in there. But I tend to look at 3 ETFs to get a better read on the different parts of the energy sector. And the way to think of this, if you're not familiar with energy, here's your quick tutorial. You've got companies that pull stuff out of the ground, call those upstream companies. Those are E&P stocks, exploration and production. Their job is to go drill for oil and get it out. The XOP is a good ETF that kind of tracks those companies. There's a bit of like mixing a bit, but generally these are pretty good for that. So here's the XOP. You can see from a technical perspective, big shooting star candle here, which we noted a couple weeks ago. That's as we're retesting the September peak. So bad news with the candle pattern being quite negative as we retest that peak from the third quarter. We're now back to the 200-day moving average. And so overall, this has just been an underwhelming chart. On an absolute basis, we've been sideways. The relative performance has been pretty weak for the last 6 months. So these companies tend to be tied primarily to the price of crude oil, because that's literally what they're getting paid to do. And the more they can sell their oil for, the better they're going to be doing. Then you have this ETF, the XES. This is oil and gas equipment and services. So these are the ones that like sell the shovels to the exploration companies, right? Here's the stuff you need, the tools you need to pull the oil out of the ground and get it out to consumers. That's what equipment and services companies do. The XES is a good one. There are a couple, like the OIH is an oil services ETF, which is another one to follow. This one a little more impressive from a technical perspective, right? Look at chart 1. This is oil producers or exploration stocks sideways. Here's equipment and services generally trending higher highs, higher lows. Today, we did sell off almost 5%, but for now, we're holding the 50-day moving average. That's where these previous pullbacks have dropped to, and then it's held up pretty well. Then you have pipeline companies, which I'm not showing here. Those are kind of midstream, right? The companies that get the oil from wherever it's drilled to wherever it needs to get to. And then you have oil refiners that actually turn the oil into gas you're putting into your car, whatever you're using it for, right? And CRAK, C-R-A-K, is a VanEck ETF that tracks that particular area. You call these the downstream companies, maybe pretty well. Same, similar to what we saw with the oil services companies, but in this case today, we're actually breaking down below the 50-day moving average. Now, oil refiners tend to do a little bit better because if they have to pay less for the oil, that's actually probably better for them because they're trying to turn it into something else. So the lower their supply, the better. So lower crude oil prices can actually be better for these companies. You can see it's down a lot less than like the other ETFs, right? We can see that oil production and exploration down almost 4%. We can see equipment and services down 5%. Oil refiners down 2.5%. So down, but down less. But I'm concerned about this break of the 50-day moving average. From a technical perspective, right, we've had a couple of these pullbacks to a 50-day moving average. The RSI has held at 40. And I learned this technique from the late Connie Brown and her book, Technical Analysis for the Trading Professional, talking about the phased movements of RSI. That was a life changer for me as a technician when I learned about that way of rethinking about RSI ranges. So thanks again to Connie for that contribution. Also, Andy Cardwell did a great job popularizing that as well. So according to their work, right, we've pulled back to a meaningful moving average. We pulled back to where the RSI, it's about as low as we'd want it to get before we have to think about this as a new downtrend phase, maybe a head and shoulders top of sorts and a break of the neckline. So all of these energy ETFs, none of them looking particularly great. I would say out of those three, that middle one, the equipment and services, probably looking the most constructive, and that it's pulling back to moving average support and not holding it yet. But weaker crude oil prices, a big concern for the energy sector. To finish off here, just a couple more charts because I knew I wanted to dive a little deeper into the energy space. McDonald's, not a good sign if you're all bulled up on McDonald's, because we've been trying to get above this 320, 325 level going back to the beginning of the year. Here's in Q1, here in Q2, here in Q3, and now again in Q4. We get up to 320 to 325, and that's where we stalled out today. We have a bearish engulfing pattern, a big up day, a big down day. Day two's open to close range engulfs day one's open to close range. If you're a bar chart person, as I usually am, you call it a bearish outside day, whatever you call it. It says short-term sentiment more negative, tells you the next 1 to 3 bars are more likely lower than higher. Probably implies that a big break above 325 not happening through the remainder of this week. Let's finish off on a strong chart in a strong sector. Industrials have been an interesting sector on that value. The chart showing you the relative performance of value sectors. Industrials were impressing, along with some of the other value sectors. Airlines in some diverse patterns in the airline space right now. But I like the chart of UAL bouncing off of the 200-day moving average, making a new 3-month high today, pushing above 110. I think holding that breakout level would be pretty meaningful. Almost a cup and handle pattern here with a rounded pattern surrounded by a shallower pullback. We're breaking above that rim of the cup around 110. I think that's a strong chart, improving momentum, improving relative strength. Strong chart getting stronger. Folks, that'll do it. Thanks so much for joining me here on Chart This with Dave Keller on Tuesday, December 16th. Thanks so much, as always, for taking a moment to drop your questions in the comment section on our YouTube channel. You can go to marketmisbehavior.com/lessons for information about our upcoming webcast tomorrow, 10 a.m. Pacific, 1 p.m. Eastern. I will hope to see you there. Please sign up, and I'll make sure I let you know all the details. That'll do it for today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.